What occurs when the world's largest supplier of a critical industrial metal quietly halts exports while the rest of the globe is celebrating New Year's Eve? We are about to find out, because China has just executed one of the most consequential resource maneuvers in modern history, and the majority of Americans have no idea that it even took place. On January 1st, 2026, exactly 4 days ago, China implemented new export licensing rules for silver that effectively ring-fenced between 60 and 70% of the world's refined silver supply for domestic consumption. And they did it not gradually, not with warnings, but overnight. The rules changed suddenly, and the global silver market immediately discovered that the metal powering our smartphones, solar panels, and electric vehicles has become drastically harder to access. Here is how they accomplished this. The new regulations require any Chinese exporter to demonstrate that they produced at least 80 tons of silver annually, and maintained consecutive export records from 2022 through 2024. On paper, this may sound reasonable, yet in practice, this standard effectively excludes roughly 90% of Chinese silver exporters from participating in international trade. Consider the implications. 9 out of every 10 companies that previously supplied silver to Western manufacturers can no longer ship product across Chinese borders. China accounts for roughly 40% of the world's refined silver production. But when factoring in their control over processing facilities, refining capacity, and integrated supply chains across Asia, their actual influence over the available global supply reaches closer to 60 to 70%. And now, with a single regulatory change enacted while our markets were closed for the holiday, China has essentially nationalized that entire supply stream for its domestic industrial base. The timing of this action is far from accidental. China is constructing the world's largest renewable energy infrastructure, producing more electric vehicles than the rest of the globe combined, and racing to dominate semiconductor manufacturing. Every one of these technologies requires silver, substantial amounts of it. The average solar panel contains approximately 20 grams of silver. Each electric vehicle incorporates between 25 and 50 grams, depending on the model. Smartphones, laptops, and the 5G infrastructure being deployed across cities all rely on silver's unique electrical conductivity properties, which no other material can fully replace. While Western governments spent recent years discussing critical minerals and supply chain security, China was actively securing the supply chains themselves. They did not announce their intentions. They did not telegraph their policy shift. They simply changed the rules on January 1st and locked down the resource. Here is where it becomes particularly interesting for Americans, whether investors or citizens. Silver reached $75.86 per ounce yesterday, January 5th, 2026. That represents a 153% increase from the level seen just 12 months ago in January 2025. Pause and consider that trajectory. In a single year, silver has more than doubled in value, yet most mainstream financial media has scarcely covered this story. But price movement alone is only part of the picture. What demands attention is the state of physical inventories here at home on the COMEX exchange in New York, the primary market where silver futures trade and where American institutional investors, manufacturers, and refiners access physical metal when they need it. COMEX registered inventories have fallen by roughly 70% since 2020. Today, they sit at approximately 23 to 28 million ounces of registered silver. That is the metal physically available for delivery against futures contracts. To contextualize this, it represents the lowest level seen in more than 15 years and accounts for only about 4 to 5 days of global industrial consumption. Just 4 days of supply backing a market in which paper contracts trade as if the metal were unlimited. Consider the math. This should alarm anyone holding silver futures contracts or anyone manufacturing products that require silver. Current COMEX open interest, the total number of outstanding futures contracts, represents roughly 1 billion ounces of silver. Yet the exchange holds only 23 to 28 million ounces of registered inventory for delivery. This produces an ownership ratio of approximately 42 paper claims for every single physical ounce held in COMEX vaults. Let me give you a concrete analogy. Imagine buying a concert ticket, arriving at the venue, and discovering that 42 tickets were sold for every available seat. Then imagine the venue announces that the ticketing company cannot supply additional seats from their usual sources. That is precisely what has just occurred in the silver market. Except instead of concert tickets, this concerns a critical industrial commodity supporting major sectors of the global economy. The situation becomes more intense. Starting January 9th, this Thursday, the Bloomberg Commodity Index begins its quarterly rebalancing process. This is an automatic mechanical procedure that occurs every 3 months, requiring major index funds to adjust their holdings to meet prescribed weightings. Silver's recent price surge has caused its weighting in the index to exceed the prescribed allocation, meaning these funds are mathematically obligated to liquidate over $5 billion, worth of silver futures between January 9th and January 14th. Consider the convergence of events. China just restricted 60 to 70% of the global silver supply on January 1st. COMEX inventories are already depleted to 15-year lows with a 42-to-1 paper to physical ownership ratio. And now, passive index funds must offload $5 billion in silver futures, approximately 13% of the exchange ADER's total open interest, into a market that is already under severe strain, all within just 5 trading days. If you are wondering why silver has surged 153% in 12 months, you're beginning to see the pressure accumulating within the system. But here's what should truly capture attention. Physical silver is currently trading at approximately $130 per ounce in Tokyo and Dubai, while the paper price on COMEX sits at $75.86. That represents an 80% premium for physical metal over paper contracts. In other words, if you are an industrial user who actually requires physical silver to manufacture products, you are paying $130 per ounce in Asian markets. Yet if you are a financial trader buying futures contracts in New York, the screen shows $75.86. This disconnect between physical and paper markets is abnormal. It occurs only when the physical metal becomes scarce, and industrial users begin bypassing paper exchanges to secure tangible supply. China enacted this export licensing change 4 days ago, while our markets were closed during the New Year holiday. And the Bloomberg rebalancing begins in 3 days, injecting $5 billion of selling pressure into a market already operating on fumes. The physical premium demonstrates that industrial buyers worldwide are already scrambling to secure metal at any cost because they understand what is coming. The trap is closing. The pressing question is no longer whether something will break in the silver market over the next 2 weeks. The question is, what will happen to the industrial base, technology sector, and investment portfolios when it does? Once the global community recognizes that China locked the vault and discarded the key, the scramble for whatever physical silver remains accessible to Western markets will make this 80% premium seem modest by comparison. American investors deserve to understand these dynamics before that moment arrives. If this sounds dramatic or conspiratorial, consider this. The smart money has already moved. They repositioned themselves using the exact playbook Michael Burry employed prior to the 2008 financial crisis, betting against the system while everyone else remained unaware. J.P. Morgan Chase, one of America's largest financial institutions and historically a dominant force in precious metals markets, executed what may be the largest position reversal in commodity trading history. And the majority of Americans have no awareness of it because it unfolded quietly over multiple years, while mainstream financial media focused elsewhere. Here is the story, and the numbers will clarify everything you need to understand regarding what the largest banks in the world believe is imminent in silver markets. For many years, J.P. Morgan held an enormous short position in silver. A short position means the institution was essentially wagering that silver prices would decline. They sold silver they did not actually own, intending to repurchase it later at lower prices to capture the difference. According to data from the Commodity Futures Trading Commission and analysis from precious metals researchers, J.P. Morgan's short position at its peak totaled roughly 200 million ounces of silver. That is not a typographical error. 200 million ounces that they sold without owning, betting that prices would drop. Such a position provides tremendous influence over market prices. When you're short 200 million ounces in a market where global annual mine production runs approximately 850 to 900 million ounces, you are a major driver of price discovery. Your trading actions, your ability to supply paper contracts, and your willingness to defend certain price levels all shape daily trading in silver. But something changed. Beginning around 2011 and accelerating dramatically after 2016, J.P. Morgan began systematically reversing this position. They started covering their shorts, buying back the 200 million ounces they had sold, and they continued buying month after month, quarter after quarter, year after year. Physical silver in their vaults accumulated steadily. Current estimates indicate that J.P. Morgan has now amassed approximately 750 million ounces of physical silver. Let that sink in. 750 million ounces, roughly 75% of total annual global mine production. It is the largest private silver stockpile in recorded history, held by a single American financial institution that spent years betting against silver before fully reversing its stance. Consider the scale. J.P. Morgan transitioned from a 200 million ounce short to a 750 million ounce long position, a net change of 950 million ounces, exceeding a full year of global silver production. You do not execute nearly 1 billion ounces of net position change in a commodity market without extraordinary conviction regarding future prices and an unmatched understanding of supply and demand fundamentals. For those familiar with the 2008 financial crisis, the parallel is clear. Michael Burry, depicted in the book and film The Big Short, identified systemic market imbalances while everyone else remained blind. He understood the structural mispricing of mortgage-backed securities relative to underlying risk and bet using credit default swaps. The system resisted, and his position initially appeared irrational. Yet Burry understood the mathematics. When a structural mismatch exists between market perception and reality, eventual correction is inevitable and violent. JP Morgan's actions mirror this strategy. For years, the bank participated in the paper silver market, trading contracts as if unlimited physical metal existed. They were short, profiting from suppressing prices and perpetuating the illusion of abundance. At a critical point, after analyzing industrial demand, Chinese production and consumption patterns, and collapsing COMEX inventories, they recognized the paper market had diverged irreversibly from physical reality. They replicated Burry's approach, covering shorts, accumulating the largest physical silver position in history, and waiting for the market to realize the scarcity they already knew existed. The evidence of a structural supply deficit is not speculative. According to the Silver Institute, global silver markets have experienced deficits for 5 consecutive years, from 2021 through 2025. A deficit indicates that total demand exceeded supply from mine production and recycling. The gap was filled by drawing down existing inventories. In 2025, total demand reached roughly 1.24 billion ounces, while total supply from mining, recycling, and government sources totaled about 1.01 billion ounces, a deficit of 230 million ounces in a single year. This explains why COMEX inventories fell 70% since 2020, reaching 15-year lows. Inventories have been depleted continuously to satisfy industrial demand. Industrial consumption now represents roughly 60% of silver demand. This includes solar panels, electric vehicles, 5G infrastructure, semiconductors, medical devices, and water purification systems. The solar industry alone consumed about 161 million ounces in 2024, with demand expected to grow as renewable energy expands globally. Each electric vehicle requires 25 to 50 grams of silver. The ongoing global transition to electric mobility ensures continued growth in silver consumption. But the 5G infrastructure build-out also demands significantly more silver per unit than previous technologies. Critically, new primary silver mines are not coming online. Mines where silver is the principal product require years of development, billions of dollars in capital, and sustained high silver prices to justify investment. Most silver production is a byproduct of copper, lead, or zinc mining. Supply is therefore inelastic. Even if silver prices double or triple, primary supply cannot expand rapidly because it depends on the economics of other metals. Rising demand combined with static supply and depleted inventories inevitably leads to a supply wall. JP Morgan anticipated this, positioning themselves with a physical stockpile that cannot be created from paper contracts or derivatives, metal stored in vaults, available to deliver or hold indefinitely. The bank's positioning became even more aggressive in late 2025 as pressure on COMEX intensified. In December, the exchange faced delivery demand for approximately 65 million ounces of silver. Consider what that means against a registered inventory base of only 23 to 28 million ounces. Traders and industrial users were demanding more than double the amount of silver that the exchange actually had available for immediate delivery. Rumors began circulating that COMEX was pushing cash settlement, essentially telling contract holders, "We cannot deliver the silver you are contractually entitled to, so we will pay you the cash equivalent instead." Whether those rumors were accurate or not, the Chicago Mercantile Exchange, which operates COMEX, issued Advisory Notice 25393, raising margin requirements to $25,000 per contract. This action was designed to prevent what they feared was coming, a delivery squeeze that could collapse the entire paper-silver market. When an exchange dramatically raises margin requirements, they are effectively saying, "We need to reduce the number of participants who can afford to hold contracts and potentially stand for delivery because we do not have enough physical metal to fulfill obligations if too many people demand actual silver instead of merely trading paper claims." This is exactly the scenario Michael Burry understood in housing markets. When paper claims exceed the underlying asset and the fundamental mismatch becomes severe enough that rules must be changed to prevent collapse, the system is in the late stages of a structural crisis. The reconciliation between paper and physical silver is inevitable. The only remaining question is what triggers it and when. JP Morgan is positioned on the correct side of this trade. They hold 750 million ounces of physical silver. They are not exposed to paper contract risk. They are not vulnerable to COMEX running out of inventory or altering settlement rules. They own actual metal stored in their own vaults. They can simply wait for prices to reflect the reality of industrial demand exceeding available supply. The bank that was once short 200 million ounces, profiting from silver stagnation, is now sitting on the largest long position in history. This is not speculation or conspiracy theory. This is mathematical fact based on publicly available data about their silver holdings. When the largest financial institutions reverse course so dramatically, flipping from maximum short to maximum long and accumulating more physical metal than entire countries possess, it is no longer a bet. They are positioning for mathematical inevitability. They are preparing for the moment when the rest of the market finally realizes what they already know. With China's export lockdown now in effect, COMEX inventories at 15-year lows, the Bloomberg rebalancing forcing $5 billion in liquidations starting Thursday, and physical premiums already at 80% over paper prices, that moment is approaching rapidly. Let us examine what occurs over the next 9 days. Not speculation, not theory, but mathematical inevitability based on how commodity markets operate when multiple crisis points converge. We have established that China cut off 60 to 70% of global refined silver supply on January 1st. We have established that JP Morgan is positioned long with 750 million ounces, while COMEX inventories have collapsed to 23 to 28 million ounces. Now we need to understand what happens when $5 billion in forced institutional selling hits this already fragile market between January 9th and January 14th. The Bloomberg Commodity Index rebalances quarterly. This is not a discretionary decision by a portfolio manager who can delay or adjust. It is a mechanical process governed by index methodology rules, executed regardless of underlying market conditions. Think of it as a computer program running on autopilot. It does not consider inventory levels, Chinese export restrictions, or physical premiums. It executes the prescribed rebalancing according to its mathematical formula. Silver S weighting in the Bloomberg Commodity Index must be reduced from approximately 9% to under 4% during this rebalancing window. The reason is straightforward. Silver's price surge over the past year pushed its market capitalization too high relative to other commodities in the index. To maintain prescribed weightings across its basket of commodities, passive funds tracking this index must sell silver and rebalance into other components. The scale of this forced selling is massive. Over $5 billion in silver futures must be liquidated in just 5 trading days. To contextualize, this represents roughly 13% of total open interest on COMEX. 13% of all outstanding silver futures contracts across the entire exchange. This is not a minor adjustment. This is a significant portion of the market, ES paper contracts being dumped in less than 1 week. COMEX has 23 to 28 million ounces of registered silver available for delivery. Global industrial consumption is approximately 3.4 million ounces per day. That means the entire registered inventory represents only 4 to 5 days of worldwide industrial demand. Just 4 to 5 days of the metal that powers solar panels, electric vehicles, semiconductors, and critical infrastructure. When $5 billion in futures contracts are sold into a market with so little physical backing, 3 scenarios are possible. Either prices collapse violently as paper selling overwhelms the system, or industrial users and investors step in to purchase futures at discount prices and immediately stand for delivery, draining remaining inventory, or the exchange changes settlement rules to prevent delivery, essentially admitting that the paper market no longer reflects physical reality. Based on current physical market dynamics, a price collapse seems unlikely. Physical silver is trading at $130 per ounce in Tokyo and Dubai, while COMEX paper contracts are priced at $75.86. That 80% premium indicates industrial users and sophisticated traders are bypassing paper exchanges entirely, understanding that futures prices do not reflect the actual cost of obtaining physical metal. When physical premiums reach this level, normal arbitrage mechanisms fail. In a functioning market, if physical silver trades at a significant premium to futures, arbitrageurs would buy futures, stand for delivery, and immediately sell physical silver at higher prices, narrowing the spread. That is not occurring at scale, indicating either insufficient registered inventory on COMEX or uncertainty in settlement procedures. Both scenarios signal a severely dysfunctional market, one shock away from total breakdown. Now, add the Bloomberg rebalancing to this fragile environment. Starting Thursday, January 9th, passive index funds will dump $5 billion in silver futures over 5 days. This selling pressure hits a market where industrial users are already scrambling for physical supply. Chinese exports are locked down, COMEX inventories are at 15-year lows, and the physical paper price disconnect has reached historical extremes. The likely outcome? Industrial users recognize the futures market selling as an opportunity to secure physical supply at paper prices before the arbitrage window closes. They begin standing for delivery in size. COMEX registered inventories, already at 23 to 28 million ounces, could drain to single-digit millions or potentially zero in days. At that point, the exchange faces a stark choice: either suspend physical delivery entirely, forcing cash settlement, or allow inventories to fully deplete, admitting that the paper market is divorced from physical reality. Industrial demand is enormous. The semiconductor industry requires approximately 50 million ounces annually. Solar panel manufacturers need over 160 million ounces. Electric vehicle production consumes tens of millions more. Silver's electrical and thermal conductivity, along with reflectivity, makes it essential. There are no substitutes at current technology levels, and partial substitutes involve costly retooling and efficiency compromises. When industrial users see paper trading at $75 while physical silver trades at $130, with Chinese supply locked down and COMEX inventories on fumes, they secure every available ounce at any price. Premiums that would have seemed absurd 6 months ago become necessary to prevent production shutdowns and supply chain failures. Major financial institutions now recognize this reality. Bank of America projects a base silver price of $193 per ounce for 2026. UBS projects $194. These are not fringe predictions, but research-based estimates from major banks analyzing fundamental supply-demand trends. Some analysts project even higher targets, ranging from $100 to over $400 per ounce by year-end, depending on how quickly the supply crisis resolves and whether new production can come online. The next 2 weeks are critical. The Bloomberg rebalancing, January 9th through January 14th, will force massive selling. Industrial buyers may step in, draining COMEX inventories from 23 to 28 million ounces to single-digit levels. The paper market will either survive or collapse. Confidence in COMEX as a delivery mechanism will be tested. The potential exists for physical premiums to spike dramatically, mirroring the Tokyo and Dubai markets, signaling a scramble for actual silver in North America and Europe. For American investors, manufacturers, and anyone dependent on silver, the next 9 days are decisive. JP Morgan did not accumulate 750 million ounces randomly. They positioned for a mathematically inevitable supply crisis. China's January 1st export restrictions are strategic, not isolated policy changes. 5 consecutive years of structural deficits, 70% depleted inventories, and now restricted supply from the world's largest exporter. These factors converge now. The trap is closing. The collision is imminent. Like Michael Burry in 2008, the smart money is already positioned. The rest of the market is about to discover what has been hiding in plain sight the entire time.